5 mistakes to avoid when refinancing your mortgage. So you're thinking about refinancing your mortgage, and I want to share 5 things that many homeowners do that cost them thousands of dollars. In this video, I'm going to cover how mortgage rates are determined, and then I'm going to share 5 mistakes people make when refinancing their mortgage and how you can avoid them. I'm Darren. I'm a licensed real estate agent and loan officer in California. My channel's dedicated to educating people just like you so you can build wealth through real estate. Before I go any further in the video, I just have to say, before you refinance, make sure refinancing actually aligns with you and your family's long-term financial goals. If you're not interested at all about how mortgage rates are determined, that's fine. You can just skip ahead to the part where I share the 5 mistakes about refinancing. If you are interested in learning about what impacts mortgage rates, then watch this part. All right, let's talk about how mortgage rates are determined. So there's going to be 3 main factors, and some of those factors are going to be in your control and some are not going to be in your control. The first factor, economic factors, and these are things that are out of your control. The first one is inflation. If you don't know what inflation is, that's totally okay. Inflation is just the rate at which general level of prices for goods and services rise over a period of time, which leads to a decrease in purchasing power. So it means that with the same amount of money, you can actually buy fewer goods and services. So the US economy, they're usually striving for a 2% inflation rate. At the end of 2024, we were closer to 3%. And inflation is always a hot economic topic, and it does have a big impact on mortgage rates. The second economic factor that impacts mortgage rates is treasury yields. The treasury yield is the interest rate the US government pays investors for lending money. And they do that by purchasing treasury bonds, notes, or bills. Historically, mortgage rates track with the 10-year treasury bond yield. So when yields increase on the 10-year treasury bill, mortgage rates typically increase as well. The third economic factor that plays a part in mortgage rates is economic growth. So in times of a strong economy, meaning you have low unemployment, that typically increases the demand for both housing and mortgages. So this usually increases the interest rate. Another economic factor for mortgage rates is the Federal Reserve and monetary policy. If you are someone that follows economic news, you're usually pretty aware of the Fed doing rate cuts. That is the federal funds rate that is being changed by the Federal Reserve. And the federal funds rate impacts the cost of borrowing to banks and other large institutions. So the federal funds rate does not always directly impact mortgage rates, but it does change the cost for banks to borrow money. Because it does that, it has an indirect impact on mortgage rates. The last economic factor that impacts mortgages is the current demand and market for mortgage-backed securities. And let me explain what a mortgage-backed security is. Lenders bundle mortgage loans into securities and sell them to investors. A big pile of mortgages, put them all together, and you sell that as an asset to investors. So if the demand for mortgage-backed securities is really high and they have lots of buyers, lenders can offer lower rates. While if the demand is kind of low for them, they have to increase the rates to attract more investors. If you've seen the movie The Big Short, they do a great job explaining what mortgage-backed securities are and how they actually led to the 2008 financial crisis. All these different factors related to the economy have an impact on mortgage rates. And unfortunately, you don't have control of these factors, but you can be aware of these factors so you understand what's going on with the market. The second main category of factors that impact mortgage rates are lender specific. So you kind of have control of this. I'll explain a little bit later in the mistakes. Just know that individual lenders determine rates, but the big thing to take away here is that lenders determine the rates that they offer based on their business strategy and their risk tolerance. What does business strategy and risk tolerance mean? So first, we can go back to that Fed fund rate, right? A lender's business strategy is going to depend on at what cost can they borrow money, and then at what rate can they lend it out. So these lenders have to make money off of the money that they are borrowing as well. That's what that Fed fund rate I talked about earlier is. The next thing is competition, right? If lenders aren't funding enough mortgages, because their competitors are offering way better rates, they're probably going to have to lower their rates. Last but not least, for lenders, they all have different risk premiums. So one lender might take on riskier credit profiles because they want to be able to have higher interest rates, while another lender might be the opposite. They're really, really risk adverse. They prefer to take borrowers with high credit scores, stable income. They have really, really strict guidelines on who can qualify for a mortgage through them. And why do I say you can kind of control these lender specific factors? Is because ultimately you get to pick what lender you want to work with when you refinance. The last factor that has a part in interest rates is borrower specific factors. And these are the things that you can control. So I just talked about lenders and their different appetite for risk. So as a borrower, when the lenders are looking at your credit profile, they're going to be looking at your credit score, they're going to be looking at the loan to value, and they're going to be looking at the debt to income ratio. And with credit score, typically when you have a higher credit score, that means you get a better interest rate. You've proven over time that you repay your debts. Loan to value just means how much loan compared to the value of the home. So if you have a $200,000 home and you have $100,000 in equity, you have a loan to value of 50%. The lower the loan to value typically means a better interest rate. And last but not least, debt to income ratio. If you have a higher debt to income ratio, that means you'll probably get a higher interest rate because you have these financial obligations and you only have a certain amount of income to cover it. So lower debt to income ratio typically means lower interest rate. If you want more details on these borrower specific factors, I actually made a video that details these factors for you. All right, so quick overview, the things that you can control for mortgage interest rates. First, you can compare different lenders, right? Although the lender specific factors are lender specific, you control which lender you want to work with. The other factors that you can control are your credit and your debt to income. So typically if you have higher credit, lower debt to income, you're going to get a better interest rate. And what you can't control is the economy. You can stay informed, but you don't have much control over inflation or what the Federal Reserve does. Another thing to keep in mind before you refinance is mortgage interest rates are typically a little bit higher than purchase rates. Don't be shocked if your interest rate is, 0.25% higher than a purchase. Now we've talked about how the sausage is made in terms of interest rates. Now let's go over the 5 mistakes that people make when they refinance. Number 1, they only look at the interest rate. Number 2, they don't calculate the total cost of refinancing. Number 3, they extend the term of their mortgage every time they refinance. Number 4, they don't shop around. And number 5, trying to time the market perfectly. Now I'm going to explain why these are mistakes and how you can avoid them. Only looking at the interest rate. If you only look at the interest rate, you're not looking at the entire picture, right? There's going to be costs associated with refinancing, and you have to take those into account. So when you refinance, look at if you're paying points, what the processing fees are, and if you have any junk fees in there. You need to take into account the APR, the annual percentage rate. This will give you a complete picture of the actual cost of refinancing. And speaking of interest rates, a question I get all the time is, what are the current interest rates? I send a weekly email that gives current mortgage interest rates. If you're interested in staying up to date with that, go ahead. There's a link in the description below. Mistake number 2, I kind of touched on it in mistake number 1. You're not looking at the total cost of refinancing. When you're thinking about refinancing, it's really important to know when the break even is. All the break even is the time it takes for you to recover the cost that you paid for your refinance. So I'll just make a simple example here. Let's say you save $250 a month because you refinanced, but it costs $6,000 to refinance. In this situation, it would take 24 months to recover your closing costs. The general break even that makes sense is 3 years. So most people, they're staying in their home for around 7 years before they either sell or they refinance again. But 3 years, you've recovered your savings and then you're getting additional savings for the most part. Now, another thing to consider is many lenders will say there's a thing called a no cost refinance. So you don't pay anything out of pocket. But what they're just really doing there is they're taking the cost and adding it to your loan balance. So you actually might be paying more interest over the life of your mortgage. And that leads me straight into mistake number 3, extending your mortgage every time you refinance. So many people, they just look at that monthly payment and they look at the monthly savings. They go, wow, I'm going to save $500 a month, but they've already paid off 15 years of their mortgage. So why would they want to reset back into 30 years? If you're planning on owning that home for 30 years, I would keep the term at 15 years. That way you could be completely out of debt by the end of that 15 years and your mortgage would be paid off. In the long run, this will save you lots of money over the life of your mortgage. Obviously, everyone's situation is different. Everyone's long-term goals are different. Everyone's stance on debt is different. I was raised in a family that does not really believe in having debt or, having minimal debt. So I totally respect people that want to pay their mortgage off as soon as possible and have a paid off home. I've also met people that have a different stance and they're using their debt to create more wealth. So as I said in the beginning of the video, think about you and your family's long-term financial goals and take these factors into consideration. Mistake number 4 applies to everyone. This one is not shopping around. You'd be surprised at how many people I talk to only get one quote for their mortgage, and later they find out they could have saved thousands of dollars up front and they were still paying more interest over the life of the loan. This is where I highly recommend you shop around. I'm not saying talk to 10 different people, but maybe get 2 or 3 different quotes. And that way you can compare rate and cost for that rate. And just keep in mind, if you do get a hard credit pull, multiple mortgage credit inquiries within 45 days typically are not negative towards your credit score and they count as one inquiry. So this is one of the main things that you can control when it comes to interest rates. So I recommend it for everyone. And if you want to chat about your scenario, feel free to email me directly. And last but not least, this is a mistake that many people made last year, is they tried to time the market. Waiting for lower interest rates means that you might be missing out on savings. And because we don't have control over the economy, we really don't know where interest rates are going to go. As much as every lender loves to give a prediction about rates going up or down, the reality is we just talked about a bunch of things that are not in our control. And if they did know where interest rates were going to be, they wouldn't be selling mortgages. But the most important thing is that if the numbers make sense and you are going to get savings at a reasonable break-even time, then move forward, because waiting for lower interest rates means that you could be missing out on current savings. And we just covered a bunch of factors related to the economy that we can't control. So no lenders can predict the future and they can guarantee that rates are going to go up and down. But what we do know is that if the numbers make sense and you can save money at a reasonable break-even time on a refinance, that's a good time to do it. A good example is September of 2024. Mortgage rates dropped that month and there was so many people thinking about refinancing, but they ended up not doing it because they just weren't sure and they thought rates were going to go lower. And what has happened since then is that rates actually went up. So they've lost their opportunity for savings and we don't know when they'll have that opportunity again. And if there's one thing that I really want you to take away from this video, it's that nobody knows exactly where mortgage rates are going to be, especially in 2025. But what we do know is that your success depends on your preparation more than anyone's predictions. So let me say that again for you. Your success depends more on your preparation than anyone's predictions. As always, thank you so much for watching my videos. If you found this video helpful, I'd really appreciate it, and I'm sure they would too, if you could just share this with someone you know it would help.